Gold is moving, and it's not just in price, it's physically moving all over the world. Alasdair Macleod joins us today to tell us exactly what's happening, where it's going, and why. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Alasdair Macleod joins us today. Alasdair is the author of the Macleod Finance Substack, and he is an educator for sound money, and he helps to demystify finance and economics. And his many titles include a stockbroker, banker, and economist. And we're delighted to have Alasdair join us once again today. It's time to saddle up and silver up for Alasdair Macleod. Alasdair, welcome back to SBTV. How are you doing?
I'm fine. Thank you for having me back, Patrick.
Glad to have you back. Alasdair, I want to first start off by something we talked about the last time, and that was the gold movement from the UK to the US. And you had said something along the lines at that time of this is a gold run, a run on the system, meaning the paper gold market was now wanting physical delivery. Would you say this is still going on, a sort of a gold run of sorts?
Yes, it's still happening. There's quite a lot of confusion actually over what's happening. For example, quite a lot of people within the bullion bank system see gold coming back into the UK vaults. Now, I don't think that's quite right because really the problem I think that the bullion banks had was that when Trump threatened 25% tariffs across the board, when he first got elected, they sort of thought, well, if gold is going to cost 25% more, in America, we have got deliveries which we have got to make. We don't have the gold necessarily to cover it. And not only that, but we're going to have future deliveries. So you can see why there was this panic, if you like, to move over. And the one thing that nobody seems to watch are the stands for delivery. I mean, they are absolutely huge. The rate at which they're running this year so far is roughly 1,500 tons for the whole year, if you extrapolate what's happened so far into the whole year. That's a lot of gold. And something like 850 tons, something like that, was what moved over, if you like, into COMEX from London, Switzerland, and also places like Mumbai, believe it or not. I mean, so the arbitrage opportunity was so great. The problem is that we don't know who is actually standing for delivery. And gradually, as the stands for delivery occur, a lot of those people who stand for delivery withdraw it from the COMEX warehouse system. And that is now what we're beginning to see, because the level of stocks within COMEX warehouses is now beginning to decline. It's still very high, but it's beginning to decline. And this was something that happened after the spike. If you remember, at the time of COVID, later on that year, there was a similar situation where you had a spike, if you like, in gold going into COMEX. You had the premiums again on futures, which were driving it. And you ended up with far higher levels of gold bullion in the COMEX warehouse system. Gradually, after that happened, the level of gold in the warehouses actually diminished, and it went down and down and down until this recent spike up. And I calculated that in about the last 4 calendar years, something like 2,100 tons of gold had been stood for delivery. Now, of course, some of that may be between bullion banks. I mean, we really don't know the answer to this. But the other thing that we are seeing is that the managed money category on COMEX is having less of an influence on things. I mean, you've got a pretty low level of outstanding open interest. I mean, it's around about 417,000, which is pretty low, particularly when you see gold going up to new highs. And I think the other thing about this was that the rapid pace of gold going out of the Bank of England's vaults. Now, I mean, some of that, might have been, sort of, if you like, owned without future obligations, if I can put it that way, lease obligations, as it were, by commercial entities. But I'm sure that some of the gold that went out was probably leased gold. In other words, you see, when you lease gold, it becomes your property. If you're the lessor, it becomes your property until, under the terms of the lease, you return it. I mean, it's exactly the same like you go down to the local, sort of hardware place and you lease, say, a lawnmower to do your lawn. That is your property until you return it. Obviously, you've got to return it as you picked it up. Yeah, but it's your property legally at that point. And it's exactly the same with gold. So a lot of this gold, I think, went out. And of course, where's it gone? Can it actually come back? I mean, the answer, I think, is that most of it probably doesn't. Most of it's probably gone into interest, if you like, in Asia. Central banks will have bought it and stood for delivery, I'm sure, and so on and so forth. But you've got to consider, where does that leave central banks who have been quite happy to lease their gold in the knowledge that the Bank of England was actually running things, sensibly, and leased gold wouldn't leave the storage of the Bank of England, because the way it works for the Bank of England is that they make a change in the register as to who owns what and all the rest of it, and they can issue a certificate to a commercial bank saying, yes, we store 100 tons of gold, or whatever the figure might be, of your gold, because it's been leased to you. It doesn't necessarily say it's it's leased, but at that stage it is a commercial entity's property. And from the point of view of central banks using this leasing thing to make gold work for them, get a little bit of interest to pay back the storage costs and all the rest of it, you begin to think, hold on a minute, is this a good idea? And I think on the margin, what's happening is that banks are withdrawing from leasing now, which will be creating a gradual tightening of liquidity within the paper markets. Not just London, but also knock-on effects elsewhere, because, the way London works is that London very often is long and it shorts, it has the short side on COMEX. That's the idea anyway. Now, whether it actually works like that, is an open question, because nobody tells us what their positions are. So, you can see that, if central banks don't play the leasing game anymore, then they're going to take the liquidity away from the markets upon which paper markets depend. So I think that's roughly where we are. And I think this is one reason why gold seems to be holding on to highs, despite the fact that the managed, if you like, the managed money, which are basically hedge funds, they just haven't bought it. There's some in there who have it, obviously. But the idea that they're really long, this is overbought, it's not overbought at all. It's quite extraordinary to have an oversold market, which is close to all-time highs. I think it's a reflection, if you like, of the systemic squeeze in the case of COMEX, particularly on the swaps.
That's pretty interesting. You're getting me pretty concerned about this gold leasing. So for some of the gold holders out there, what do you think about the gold leasing just for the regular investor out there leasing out his gold? If you're saying that you may lose or transfer your property on the lease?
I don't think members of the public lease gold at all, and I don't think many institutions do. Basically, they don't possess gold. It's under-owned, if you like. So the only lessors, the only lessors in the market basically are the central banks. If they're not playing this game anymore, then the market's just losing its liquidity. The other thing is that quite a lot of gold is leased out and it's then rehypothecated. So, if let's say you've leased it for a year or for 2 years or something like that, you don't necessarily keep it yourself. You will rehypothecate it to someone else who may rehypothecate it to someone else. This is all part of providing liquidity in the system, if you like, in a system which really doesn't have a lot of free gold. I mean, the LBMA boasts about the level of gold in LBMA vaults and all the rest of it, but a lot of that is, in fact, most of it is actually physically owned or privately owned the property, if you like, of people who are not leasing it at all. They're holding it for whatever reason. And, we don't necessarily know who they are, because if you have gold, you don't want to go shouting and telling everybody about it. I mean, most of the gold in London vaults is really for foreign institutions, foreign high net worth individuals. What they're doing, Patrick, is they're just looking at, if you like, fiat currencies, and particularly the dollar. They're overweight dollar, and they're worried about being overweight dollar. So what the central banks have been doing is rebalancing their reserves away from fiat currencies towards gold, which is legal money. So if you like, they see increased risk in the whole system. And you've only got to look at the debt situation. If you analyze the debt situation that America is in, that the UK is in, that France is in, that Spain's in, that Italy's in, and all the rest of it, basically, virtually all the members of the G7 are in debt traps, which basically means that the currencies are in a position where they're going to begin to destroy themselves if things go wrong. So do you really want to hold all those dollars? So central banks are tending to get out. And of course, this is being reflected in foreign holdings of US treasuries, for example. That's not really declining too much at the moment. I mean, one or two countries have been selling down their reserves. I mean, China, for example, you could argue that the reason they've been doing that is geopolitical rather than anything else. But, when the People's Bank goes out and buys gold, the way to look at it from their point of view is they're not buying gold, they're selling dollars. It's as simple as that.
Yeah, it's a good way to put it. But speaking of China, it's been long suspected that they have a lot more gold than whatever's being stated officially. But let's say they drop 20,000 tons of gold on the table and says to other nations, "Let's see what you have." What happens then?
They would only do that if, let's say, the dollar got into a situation where it was really collapsing and it was threatening to take down the yuan. Now, at that stage, they probably would make a declaration as to how much gold they've got stashed around the People's Liberation Army. I mean, I'm told they've got quite a lot, if you like. The youth wing of the Communist Party. I mean, you've got all these separate accounts where gold has been accumulating. So they could well turn round, if you like, under those circumstances. But I think until then, I mean, China's approach is not to go and upset everybody. It's just let everybody else make the mistakes. And then we've just got to defend ourselves from the fallout of everybody else's errors. And that's really their whole approach. And, well, I mean, you're based in Singapore, and I'm sure you sort of get the feeling that they've got this sort of almost Confucian approach. We've been around a long time, and we don't remain being around for a long time by taking hasty actions. It's not the Chinese way of doing it.
Right, agree. Alasdair, do you think though, let's say China will eventually set the price for physical gold, with the result being perhaps paper gold or maybe gold futures here in the West may not be so much anymore, or may really run into some headwinds there?
I think one way to sum it up is that China really does control the physical gold market. And I think she's seeking to control the paper market as well, or take the control, if you like, away from the West. And there are very good reasons for doing this. And it's a policy which has just accelerated recently because her response to American trade sanctions has been very much to take the view, right, well, as I said, we've got to protect ourselves. It's really what they're saying. And so they've accelerated, trade relations and all the rest of it, diplomatic relations around the ASEAN nations, of which I think Singapore is one. They've said, and this is really, I think, preparation for the protection of the yuan. They've said we will open gold vaults outside China. This is a completely new departure. And so far as I understand it, they've said they're opening one in Hong Kong and they're opening one in Saudi Arabia. Why Saudi Arabia? Because that's their biggest oil supply. So, and I actually think it's demanded by the Saudis as well. So you can see that this is sort of going into place. Now, when it comes to the paper markets, they've also opened up the Shanghai Futures Exchange to foreign institutions. And that was announced, a couple of weeks ago. And it's not just gold and silver, it's also all metals. So that, a foreign bank, say, JP Morgan or whatever, doesn't have to set up a Chinese entity in order to deal on the futures exchange. It can deal direct. Just as a Chinese bank can deal direct through Globex on COMEX. So, these are very, very important steps. It gets very little commentary, if you like, in the public arena, but I believe these are extremely important steps, and it shows a desire by the Chinese to get control over the gold market. And why do they want to do that? They want to do that to protect their own currency, because China knows that real money, as opposed to credit, is gold. And if you're going to have a fiat currency problem, then you have got to be able to protect the purchasing power of your currency by linking it to gold. Now, I think, initially anyway, really what China's looking at is looking at it from the point of view of a firm yuan for trade purposes, because obviously you've got, you've got a domestic yuan, you've got an external yuan, as it were, you've got exchange controls. So this is really something which is aimed, if you like, at protecting her position in her overseas markets. Her overseas markets being the Shanghai Cooperation Organization and also BRICS. And the reason for doing this is really, I think quite simple. She can also see that as the dollar goes down, there's got to be a currency which replaces it for BRICS trading. And the idea that you can accept other currencies, come on, they'll go down with the dollar. And in any event, a lot of these currencies are pretty, you wouldn't want them anyway. Would you really want Turkish lira, for example? I think the answer is no. Would you want, Iranian rial? I think the answer is no. So you can see that, there is a need for a currency common, if you like, to what's called the global South and Asia. And China is looking to provide it. At the moment, just providing it for non-domestic transactions to, if you like, guarantee her trade position. But I think if she does that with her overseas current, her external interests, then I think it will also help provide stability to the domestic currency. If it doesn't, then they'd have to sort of think about, extending gold protection to that currency. But it's all going to depend on what happens to the dollar.
Gold, it could be being set up as sort of the international trade currency, balance of payments, whatever it might be.
Yes, I think that's the initial stage. That's how I would see it anyway. I mean, if I was advising the Chinese government, not that they need any advice from me, then that's the way I would look at it. And I think that's the way they are looking at it.
But this is very different from you and I using gold as a everyday currency.
Well, we never use it as a currency. I mean, this is the point. I mean, people like gold bugs and also people like Bitcoin aficionados and all the rest of it, sort of don't understand that actually we do all our business in credit. I mean, it's as simple as that. If let's just say I buy something from you, I pay you out of my bank account. It comes out of a deposit, if you see what I mean. So on that basis, we never deal with each other in gold. I mean, only as a last resort would I actually part with gold to buy something from you. I mean, you might say, yeah, I'd love to have your gold, but I'm going to hang on to it. And and also this is a big, big fault of which the Bitcoin people just don't understand. They seem to think that you're going to trade, you're going to go and buy, I don't know, packets of cigarettes or dinner or whatever in Bitcoin or fractions of Bitcoin. No, you don't. That's not the way it works. Basically, the way it works is you will buy it in credit attached to Bitcoin. Your question really is, do you want to have credit attached to Bitcoin or gold? You want stability. You don't want something that's going up and up and up and up. Do you see what I mean? Gold is stable.
Yes.
While the price is rising, actually, that's not what's happening. It's the purchasing power of currencies going down. And this is the key thing, which I don't think anybody really grasps.
Yeah, I can see where you're going with this, and agree. The dollar has been falling, pretty much all year. It's lost, I think, about 9%, at least on the DXY last time I checked, and yields on treasuries, in particular the 10-year, I think it's moved from 4.18 back in April when we had Liberation Day to now roughly 4.5%, with the dollar declining and having to offer more yield to the market to get buyers to take on U.S. debt. What does this tell you?
Well, you're right about DXY. I mean, if you look at the chart, it's terrible. It's heading towards 90 and may not stop there. I mean, it really does look bad. So, the dollar is not good. Now, where it goes from there, I don't know, because remember, if the dollar really does start falling, it's going to undermine all the other currencies as well. The foreigners just got too much in the way of dollars. I mean, they own nearly $40 trillion and underlying financial instruments. It's too much. Now, if you get a contraction in global trade, which is inevitably the consequence of Trump's tariffs, then anyone who's got dollars has got too many of them. So purely on a commercial basis, there will be sellers. And then you've got the geopolitics like China and all the rest of them who are trying to move away from the dollar. And then, of course, you've got even portfolios. I mean, I think, because I released an article today, I mean, $17.6 trillion is the current valuation of overseas holdings of US equities. 17.6 trillion. I mean, just think of that. That is more than half the total of US GDP. Are they going to hang around once it's clear there's a bear market going on? So what drives the bear market? Well, the thing that drives the bear market is as the US economy underperforms, and certainly performs less than the 4.5% yield, let us say, on the in terms of growth on the US 10-year Treasury, then by definition the US is in a debt trap because it cannot service its debt. So what does that mean? It means that foreigners are going to continue to sell out of US Treasuries, US financial assets, whatever. And the only way in which that rot will be stopped is for yields to go even higher. And what does that do? It just makes the situation worse. The debt trap just gets worse. So we've got a situation really where, if this was a private sector enterprise, it's basically sliding into bankruptcy. And the first people to understand this are always the foreigners. I mean, the last people to understand it are the politicians. You can see that with Trump's behavior, the big, beautiful bill, adding God knows how much spending and budget deficit, if you like, to the whole thing. He's behaving as if this isn't a problem. He doesn't, if anybody says to him, look, we've got a problem because we've got too much debt, he'll probably turn around and say, well, if foreigners will buy dollars, they always need dollars,
Yeah, no, it's a good points that you're saying there. And the reason why I asked that question about the dollar going down and the treasury yields having to have a little bit higher offer to the market to look appealing was also because the Fed, it is at about its 2% target rate, depending on what numbers you look at or whose numbers you're looking at. But it looks like the Fed, it is going to be politely asked to continue to lower rates What's your view on lowering rates?
Let me put it this way. It's from the point of view of stabilizing the dollar, it's the worst possible thing they can do because of this debt trap situation. However, I think we're going to get into a situation where, as the credit bubble, and if you don't believe we've got a credit bubble, just look at there's a debt bubble at the moment. Now, the debt equals credit. It's the other side of it. So if you've got a debt bubble, you've got a credit bubble. We've got a credit bubble. You've also got Smoot-Hawley Mark II, Tariff Act. These are precisely the situations that America had in 1929. This time it's worse. So the way things are going to evolve is that the dollar is going to get undermined. Financial markets are going to get undermined. And the only way, in theory anyway, to stop this or slow it down is to raise interest rates, which will kill the equity market even more, but might offer a little bit of protection to the dollar. Because if you've got higher rates, then, okay, you might sell equities, but you'll probably leave the money on deposit at a bank in dollars, sort of thing. So particularly as under those circumstances, other currencies will look even less attractive than the dollar. Look at the European situation, for example, or the Japanese situation. So, one way or the other, the Fed is going to have a really difficult choice on this one. But I think eventually, as businesses and pretty fundamental businesses start going bust, which I'm just saying what happened in 1929 to 32, whether it's businesses or banks, lenders to businesses. In those days, it was the farming industry mainly, if you like. This, today could be anything. It could be high-tech businesses. I think that you'll find that the Fed will have to rescue quite a lot of what's going bust. Now, when it's doing that, how does it do it? One way in which it has to respond is to take the pressure off the economy by lowering interest rates. But it can't do that because it'll just kill the dollar and make the situation even worse. So the Fed is getting into an extremely uncomfortable position. And I think this is basically, if you're a central banker, you can see this. You can see this happening. You can see the problems and also the political pressures on the Fed to reduce interest rates. The market pressures, everybody in the market, with very few exceptions, of which I'm one, believe that interest rates will go down. Central bankers see this differently. They see this as being really an extremely dangerous and difficult situation. And would they really rather want to hold all the dollars they've got? I think they would rather lighten up, and that's what they've been doing. And they've been doing it now for the last 4 years.
Yeah, I've seen it as well. But whether rates go up, rates go down, how do you think gold is going to react to whichever way it moves?
Well, it's fascinating because recently something happened which the macroeconomists believed was absolutely impossible. And that is, you had a rise in the bond yields, a fall in the purchase in the dollars trade weighted, and a rise in gold. Now, this is impossible. We were told, absolutely impossible, but it happened. And the answer basically is that it reflects foreigners getting out of dollars. And they get out of dollars by buying gold because gold is real money, real legal money to everyone around the world. So, this is the answer to your question.
But with the tariffs, I think another point is when it was done back in the days of, I think it was Alexander Hamilton. That was a different time, different era back, when the Great Depression, that was a different era. But this time today, the world is very, very connected. And I think this brings in a different element to trying to place tariffs all over the world. What would you say to that?
I think that's absolutely right, Patrick. Basically, it is a very different world. I referred to Smoot-Hawley Tariff Act in 1930. I understand that 2 or 3% of the US economy involved trade beyond its borders. Very small part of it. Of course, that's very different today. Most of, I think, probably it is probably right to say that most of the goods manufacturing actually is done abroad. And, if something is actually sold in the US, or made in the USA, it's actually made of components which have come from abroad, either robots to manage the factory line or whatever. I mean, it's a very different situation. And the supply chains are extremely sophisticated and therefore very delicate, as we saw with COVID. I mean, everything ended up in completely the wrong place when you had that sort of sudden stop. This time, I think it's likely to be a lot more serious. And you got so many people. I mean, I find particularly Republicans, because I get quite a few comments, if you like, from arch Republicans, if I can put it that way. And I know they're arch Republicans from their support of Trump, but they deny that this trade is a problem. They say no, it's completely different for whatever reason. They don't believe in the sort of Ricardan story of comparative advantage. They say, well, but I mean, we existed on tariffs before the First World War. We're just going back to that, and we'll get rid of income tax. Oh, come on. I know that's what Trump's trying to do, but he's not. It's fairyland. It really is.
Alasdair, do you see more economic, more financial, more government instability coming down the road?
Well, it's inevitable because as the dollar falls, you're going to get higher interest rates, higher bond yields, whatever the Fed does. And that's going to create a funding crisis. That's going to get worse. It's going to undermine equities. Equities, if you look at the relationship between the yield on the long bond and equities, it has become more stretched than it has ever been in history. Now, that's a very serious statement. And I've shown charts of this. And I don't know how, whether people really understand the chart, but basically, the higher the yield and the higher the equities are, the greater the disparity. And the problem is that equities take a lot of their valuation from yield on the bond market. I mean, after all, the sort of regulator's definition of a low-risk portfolio is 60% bonds, 40% equities. High risk is 40% bonds, 60% equities, if you like. So you can see that even the regulators have tied in this relationship between bonds and equities. And through my long experience in markets going back to 1970, I have seen this. I have seen when you get interest rates or bond yields rising to the point where it trips the market. And the best example I can remember was in 1973. It was 73, when the Bank of England raised interest rates to something like 10% because we had a crisis, typical crisis. We couldn't fund our budget deficit. The result of that was what we called the secondary banking crisis, which basically took out a whole raft of banks which had specialized in lending into the property market. I mean, it's just like the situation that we had following COVID. I mean, they'd reduced interest rates to zero. And in the case of Europe and Japan, into negative rates. Everybody went out, borrowed and borrowed and borrowed at zero rates, believing that rates would never go higher. And then what happened? And of course, you even had some regional banks being taken out. I mean, it's exactly the same thing. It happens time and time again. So there's nothing new in this. But what is new is the violence, I think, that we're likely to see in these markets, the violence as they fall apart. I'm sorry to say it, but it's get out of credit, get into real money, which is gold. And I think, just follow what the central bankers are doing.
Amen. Completely agree with that. Just want to touch base with your last question here. Touch base with your Substack. If you had to put a pulse on the people, what would you say is maybe the one or two questions that are most frequently asked, or the things they're most concerned with?
I think a lot of them are basically bulls of the gold bugs or silver bugs or whatever. I don't think I can really put my hand on my heart and say that huge numbers of people who are wondering what the hell's going on. I mean, yes, a lot of them, yes. But in terms of people really understanding what's happening, understanding the difference between money and credit and so on and so forth, I would like to think they come to me to learn that. And some of them do. But, in terms of the mass, as it were, I don't think that's happening yet. And of course, this is reflected in the fact that ownership of gold in terms of personal assets, portfolios, whatever, is less than 0.5%. This is not good. Yeah, I mean, it's actually unhealthy. In the if you like, in the sort of the world of equities, and how we've all sort of evolved away from gold, and we all believe the dollar is the standard and all the rest of it. I suppose in a sense it's not surprising, but if you go back to a time before that, before everybody thought the dollar was the most marvelous thing, we've all got to earn dollars, the situation was very, very different. I mean, typically a sensible portfolio would have at least 5 and probably as much as 10% or more of its asset allocation in gold or gold mines. What have they got now? Virtually nothing. And I think so there is a lot to go for, I think, in terms of educating people, helping them understand, the risks by being almost totally exposed to, if you like, fiat currency and underlying paper.
Alasdair Macleod, before we head out, can you let the good people know how they can follow you and of course, about your Substack?
Sure. So my Substack is alasdairmacleod.substack.com. I mean, if you can't spell my slightly difficult Scottish name, try just Google Macleod Finance. It'll probably take you there. And I do have a special offer on the moment, a 25% discount for your listeners, readers, viewers, if they like to participate. It's only got about 8 days to run, I think, something like that. So hurry. And you will learn a lot of life-saving tips, I hope.
No, we appreciate that, especially the education part, because I myself, I'm a gold bug, silver bug, and I can even tend to have these blinders on, and we're missing a lot of other things out there that can help us to make the proper decision. So I appreciate where you come in and you help educate people to let them really know their options out there. So I thank you for that, and I hope we can do this again soon.
That's very much my pleasure. Thank you for having me on, Patrick.
That was Alasdair Macleod sharing his views on gold, silver, and the economy. To see more of Alasdair's views and work, please do visit alasdairmacleod.substack.com. If you like this video, please do subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.